Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to a schedule of cash receipts. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 427 cash schedule of cash receipts in the practice problems tab. Closing this back up, we're going to have our information up top, and then we'll have a shorter caption of our information as we go through it in order to work our practice problem. So we have the credit sales, this meaning we had sales on credit, meaning we had a sale but didn't yet receive the cash. It's going to go through the accounts receivable. So you can imagine the process of us doing work. We send out the invoice and we expect to collect on the work that has been done at some point in the future. We have the information for September, October, November, December. We're going to be focusing in on the fourth quarter, that being October, November, December, but we're going to need September's information in order to do so. This is often the most confusing thing when we think about the cash flow projections into the future, which is in essence what we're doing. We're thinking about a schedule of cash receipts, the inflow of cash that we expect to happen in the future. The problem with doing a schedule of cash receipts is that we're first going to need, to know the sales amount, then to know the nature of those sales. Do we make those sales on account or do we make them for cash? Do we have both cash and on account sales? And then the ones that are on account, the sales that go through accounts receivable, when do we collect on those? Because we want to know when we're going to get the cash here, not when we're earning the revenue, not when the sale was made. So that's going to be one of the things when we set up your worksheet that you're always going to have to kind of figure out. It's going to be the staggering kind of problem as to the sales as compared to when we collect on the sales. So we're going to say the percent collected in the month of sale. In other words, the accounts receivable, the sales that we made on account, that we then collect in the same month. So we're going to sell them on account, meaning we give them an invoice, they owe us money, we record that in accounts receivable, and then they pay us within the same month. We estimate that 45% will be in that group, in that category. Percent collected in the following month. So in other words, accounts receivable, we have the sale, we have them in accounts receivable, we want to collect on that, but we don't typically collect until the following month, the month after the point in which we had the sale and sent out the invoice. That's going to be 50%. And then we have the percent that will be uncollectible. So we have to assume that, some of the sales that we have just based on past history, we just can't collect on them. The people just disappeared and they didn't pay us, and it is what it is. So that we're going to say that's 5%. Now this should obviously, whatever these assumptions are that we have about the collection, need to add up to 100% of, the credit sales that we will have. So the 45, the 50, and the 5 adding up to 100. So cash receipt schedule is what we're going to need. Here's just a smaller recap of this information. And remember, we're focusing in here on fourth quarter, that being October, November, December, but we're going to include September in our table. Not because I'm trying to determine the cash receipts for it, but because I want to have a standardized table from which I can pull the information, and I'm going to need that $60,000 information for the sales to figure the fact that we're going to have some of the collections on those sales in the following month, which does fall into the fourth quarter, where we are focusing in on the cash receipts in October. So that's going to be kind of the funny thing. Sometimes I'll mark this like red, I'll make it red or something like that to indicate the fact that this is just an informational component, not really part of the period that we are calculating for the schedule we are looking at, which is a cash receipts schedule. So then we got the credit sales. We're just pulling these numbers on over. These are the sales that we made. We made sales, sent out the invoice. Sales on account. We don't have any cash sales at this point. We're saying they're all credit sales. They're all going into accounts receivable. So when we make the sales, we're just imagining them in accounts receivable. We're just pulling in the sales number 60, 43, 39, 62, 60, 43, 39, 62 for September through December. Then we're going to think about the collections. That's what we actually want to focus in on here, the cash collections that we're going to have. In the month of sale, we said 45%. So then we're going to say, all right, of the sales that we made on account, they're going through accounts receivable. We've got the 43,000 times 4.45. There's the 19,350. we've got the 39,000 times 0.45, 45%, 0.45. There's the 17,550, and obviously the 62,000 times the 0.45 is the 27.9. And then we're going to say that we have the collections that happened a month after the sale. And this is where the confusion factor is, because we do what is kind of unnatural for us to do. We're kind of jumping from column to column. So I'm in this column. I typically like to add vertically, and either in this row or this column is what I like to add up. But we're going to be jumping back to September here, and that's why we have the September data. So we have the September data here, not because we're going to calculate the cash flows for September, but because we'd like to standardize this table so you can see where the computation took place. And if you work this in Excel, which I highly recommend doing, these are great tools to practice just standard formatting, everyday kind of stuff. In Excel, we will have worksheets like this or this worksheet within it. Then you want this standardization so that you can copy and paste the formula all the way across and have uniformity within the formulas that you're copying. Then, of course, you can hide this cell or something like that if you don't want to see it there for presentation purposes. So then we're going to be then picking up that 60,000 in September times the amount that we're going to collect in the month after, which is 50%. So we're going to say times 0.5, and that's going to give us our 30,000. And then, so that's going to be our 30,000 here. And then the 43, we're looking to calculate this number. So we'd be picking up the 43,000 times 0.5, and that staggers steps over here to the 21.7. And then we're picking up the 39,000 times 0.5, and that staggers on over here to the 19.5. And then that's going to give us our totals for the cash receipts, which is going to be the 19,350 plus the 30, the 49,350 for October, and then November, the 39.50, and December. This information up top, just informational information to help us out with what we want, which is the cash collections, which are going to be starting down here and below. Notice that when we think about these types of schedulings and projections into the future, we first would need to do the sales projection to think about how many units, we're going to be selling, and then what's the sales price. We need to think about the unit, sales projections first, and then we can figure out, when we're going to collect on those, our estimates of when we're going to collect on these. Remember, we're looking out into the future, so these aren't perfect. These are projections, so we have to make estimates to do that when we project out into the future, and then we can start to figure out our cash receipts. So we have to do these kind of projections in a logical fashion, in a logical order, as we move forward with them. So we'll continue. This can be a little bit more complex than this because we could have cash sales and credit sales. So this is kind of a basic setup, and we'll do a few more of these, and then we'll go into the cash payments or the outflows, which again can be more complex because we have more things that we are typically paying, and we have a similar situation with the accounts payable as with the accounts receivable, this type of staggering situation where we incur the payment before we actually make the payment, meaning we incur the expense before the cash flow happens.